Homeownership has long been seen as a symbol of security, but that assumption is starting to crack. By 2026, millions of people may discover that keeping their home costs more than they ever planned for. Monthly payments rise, hidden expenses multiply, and financial pressure builds quietly in the background. What makes this situation dangerous is how slowly it unfolds, giving little warning before options disappear. Many won't be forced out overnight, but they may feel boxed in by circumstances they didn't anticipate. Understanding why this is happening now could determine whether you stay in control of your future or react when choices are already limited. Number 1. Rising interest rates resetting mortgages. Interest rates have remained higher for longer than many homeowners expected. And by 2026, this reality could push millions towards selling. During years of low rates, buyers stretched budgets assuming payments would stay manageable. Adjustable rate mortgages and short fixed-term loans are now resetting at significantly higher levels, causing monthly payments to jump sharply. Even small percentage increases translate into hundreds of extra dollars each month, slowly eroding household stability and increasing financial stress. This pressure is amplified because wage growth has not matched borrowing costs. Many households already allocate a large share of income to housing, leaving little room for sudden changes. When rates reset, homeowners must either absorb the increase, refinance at unfavorable terms, or consider selling. Refinancing is no longer a simple escape, since stricter lending rules and higher rates often eliminate that option entirely, especially for households with rising debt or weakened credit profiles. For homeowners, preparation means understanding loan terms before resets occur, reviewing mortgage contracts, tracking reset timelines, and stress testing budgets against higher payments can reveal risks early. Some may explore accelerated payments, partial refinancing, or downsizing before pressure peaks. Rising interest rates do not force immediate collapse, but they quietly turn stable homes into fragile financial commitments, making selling feel less like a choice and more like a survival decision. Understanding interest rate cycles helps households anticipate pressure, plan exits calmly, and avoid rushed decisions that destroy equity, emotional security, and long-term stability during uncertain economic periods ahead, especially when policy shifts, global debt markets, employment trends, and inflationary forces collide simultaneously worldwide. Number 2. Property taxes rising faster than household income. Property taxes are becoming a silent pressure point for homeowners heading into 2026. Local governments face widening budget gaps caused by infrastructure repairs, healthcare costs, and reduced federal support. To compensate, municipalities increasingly rely on higher property assessments and tax rates. Homeowners often feel blindsided when annual bills rise sharply, even though their income has stayed mostly flat. Unlike mortgages, property taxes never get paid off, making them a permanent and growing obligation tied directly to home ownership. The strain is especially severe for retirees and fixed-income households. Pensions and savings rarely adjust fast enough to keep pace with tax increases. Even working families feel the squeeze as wages lag behind inflation-adjusted tax growth. Falling behind on property taxes can trigger penalties, liens, or forced bails, turning a long-term home into a financial liability. This creates a scenario where people are asset-rich but cash-poor, owning valuable property they can no longer afford to keep. Preparation starts with understanding local tax policies and assessment schedules. Homeowners can review assessment notices, challenge inaccurate valuations, and explore exemption programs where available. Budgeting future tax increases as part of long-term housing costs is essential. Rising property taxes rarely force immediate action, but they steadily weaken affordability, pushing homeowners closer to the point where selling feels like the only realistic option left. Early awareness allows families to plan strategically, avoid panic-driven decisions, and preserve flexibility, rather than reacting under pressure when higher tax bills arrive unexpectedly, and limit choices during already stressful economic periods for households across many regions. Number 3. Inflation gradually draining household savings. Inflation rarely feels dangerous at first, but over time it quietly reshapes financial reality. As prices for food, energy, transportation, and healthcare continue climbing, homeowners are forced to spend more just to maintain the same standard of living. Savings that once acted as a safety buffer shrink faster than expected, leaving families exposed to unexpected expenses. When everyday costs rise faster than income, housing payments begin competing with basic needs, turning stability into ongoing financial tension. This erosion is especially damaging because inflation affects nearly every category at once. Utility bills rise alongside insurance premiums, grocery costs, and medical expenses, creating pressure from multiple directions. Homeowners may rely on credit to bridge gaps, increasing debt while reducing long-term resilience. Over time, the home shifts from being a source of security into a fixed expense surrounded by unpredictable costs, making selling appear like the only way to regain financial breathing room. Preparation requires recognizing inflation as a long-term force, not a temporary inconvenience. Tracking real spending trends, adjusting budgets annually, and protecting emergency funds become essential. Some households explore downsizing or relocating before savings fall below safe thresholds. Inflation does not announce its breaking point, but when reserves are depleted, options narrow quickly. Those who monitor spending early can preserve flexibility, reduce forced decisions, and maintain control over housing choices, before rising prices quietly push them into selling under pressure. Planning ahead allows families to rebalance priorities, reduce vulnerability, and avoid last-minute decisions that sacrifice equity, stability, and emotional well-being during prolonged periods of economic uncertainty across households facing cost pressures. Number 4. Job market instability and income uncertainty. Job market instability is becoming a defining risk for homeowners approaching 2026. Layoffs are no longer limited to single industries, spreading across technology, finance, retail, and logistics. Automation and artificial intelligence are reshaping roles, while contract-based work replaces permanent positions. This shift reduces income predictability, making long-term financial commitments harder to sustain. Even short employment gaps can disrupt mortgage payments, insurance coverage, and savings plans, pushing homeowners toward difficult decisions they never expected to face. This uncertainty spreads slowly, affecting confidence, spending habits, and long-term household planning. Income volatility changes how households experience housing stress. When employment feels uncertain, people delay repairs, skip insurance upgrades, and rely on credit to cover routine expenses. Over time, debt accumulates while confidence declines. Lenders respond by tightening approval standards, limiting refinancing options during moments of need. A home that once felt manageable becomes a constant source of anxiety, especially when future earnings feel unpredictable or fragile. Households begin prioritizing short-term survival over long-range stability, altering financial behavior in ways that accelerate housing vulnerability across multiple income levels globally. Preparation focuses on flexibility rather than fear, building larger emergency reserves, diversifying income sources, and tracking employment risk within specific industries can provide early warning signals. Some homeowners choose to reduce housing costs before instability escalates, protecting cash flow and options. Job market shifts rarely cause sudden collapse, but they steadily weaken financial foundations. Recognizing employment risk early allows families to act deliberately, preserving control over housing choices, rather than reacting under pressure when income changes suddenly. Strategic adjustments made early often prevent forced sales during widespread employment downturns periods. Number 5. Insurance premiums becoming unaffordable. Home insurance costs are rising at a pace few homeowners anticipated, and by 2026, this trend may force difficult housing decisions. Insurers face growing losses from floods, fires, storms, and extreme weather, leading to higher premiums and tighter coverage. In many regions, policies now cost thousands more each year, while deductibles increase quietly. For households already balancing mortgages, taxes, and utilities, these insurance hikes add another fixed expense that cannot be ignored or delayed. The problem deepens when coverage becomes limited or unavailable altogether. Some insurers withdraw from high-risk zones, leaving homeowners scrambling for expensive alternatives. Lenders require active insurance, so losing coverage can violate mortgage terms instantly. Without affordable options, owners may face impossible choices between paying inflated premiums or selling property. What once felt like protection slowly transforms into a financial trigger that accelerates housing instability. Preparation begins with reviewing policies annually and understanding regional risk exposure. Comparing insurers, adjusting deductibles, and strengthening home resilience can sometimes reduce costs. Homeowners should also calculate insurance increases into long-term affordability, not just current budgets. In some cases, relocating before coverage becomes impossible preserves equity and control. Insurance pressure rarely arrives suddenly, but it compounds each year. Those who plan early avoid panic-driven sales, protect financial flexibility, and maintain the ability to choose when and how to move, rather than reacting after coverage. Disappears and costs overwhelm household stability. Early assessment allows time to adjust housing strategy gradually, explore safer regions, and align insurance realities with long-term financial planning before external forces. Remove options completely. Such preparation supports calmer decisions during unstable market conditions and stability overall. Number 6. Exploding maintenance and repair costs. Maintenance and repair costs are rising steadily, turning older homes into expensive responsibilities. Many properties purchased years ago now require roof replacements, plumbing upgrades, electrical rewiring, and structural fixes. Material shortages, stricter building codes, and skilled labour gaps have pushed contractor prices upward. What once felt like manageable upkeep now arrives as large, unavoidable expenses that appear all at once. For homeowners already managing mortgages and taxes, major repairs can quickly overwhelm cash reserves and disrupt financial stability. This pressure intensifies because repairs cannot be postponed indefinitely. Delaying maintenance often leads to secondary damage, increasing total costs over time. A leaking roof damages insulation, mold spreads through walls, and outdated wiring raises safety risks. Homeowners may turn to credit cards or personal loans, increasing debt while property conditions worsen. The emotional toll of constant repairs erodes the sense of security that homeownership is supposed to provide. Preparation focuses on proactive assessment rather than reaction. Scheduling professional inspections, building dedicated maintenance funds, and prioritizing critical repairs early can reduce shock later. Some homeowners choose to renovate strategically or downsize before repair cycles peak. Maintenance costs alone rarely force immediate selling, but combined with other pressures, they accelerate decisions. Understanding true long-term ownership costs helps households evaluate whether staying aligns with financial reality. Early planning preserves choice, prevents rushed sales, and protects equity when aging homes demand more resources than owners can sustainably provide. Clear cost projections empower families to compare renovation expenses against future income, market values, and lifestyle needs, reducing emotional bias and supporting measured housing decisions during uncertain economic periods marked by volatility and prolonged affordability pressure globally. Number 7. Declining home values in certain regions. Declining home values are a growing concern in several regional markets approaching 2026. Rapid construction during earlier booms created oversupply, while buyer demand has cooled due to higher borrowing costs. When listings sit longer, prices soften, reducing perceived wealth for homeowners. This shift affects behaviour as people feel poorer even without selling. Falling values also limit refinancing options, trapping owners in unfavourable loans. Over time, the emotional impact of watching equity shrink creates pressure to exit before losses deepen. This problem intensifies when home values drop below outstanding mortgage balances, creating negative equity. Owners cannot sell without covering the gap, yet staying means paying for an asset worth less than the debt. Mobility declines, job changes become harder, and financial stress grows quietly. In some areas, investors step back, accelerating declines further. Declining values also affect local tax bases, leading to service cuts or higher rates, reinforcing a cycle that pressures households already facing rising costs elsewhere. Preparation involves monitoring neighbourhood trends rather than relying on national averages. Tracking inventory levels, price reductions, and buyer activity reveals early warning signs. Some homeowners choose to sell while equity remains intact, preserving flexibility. Others adjust expectations and plan longer stays with reduced leverage. Declining values do not harm everyone equally, but ignoring local signals removes choice. Early awareness allows households to respond strategically, protecting long-term stability, emotional well-being, and financial control before market shifts turn gradual declines into forced outcomes. Such foresight supports calmer decisions during uncertainty and prevents panic selling that destroys equity, confidence, and housing security when broader economic pressures intensify simultaneously across multiple regions and income levels globally. Number 8. Stricter lending and credit conditions. Lending conditions are tightening as financial institutions prepare for higher default risk approaching 2026. Banks are increasing credit score requirements, demanding stronger income verification and reducing approval amounts. Homeowners who once relied on home equity loans or refinancing now face closed doors. This shift removes a critical financial safety valve that many households quietly depended on. Without access to credit, unexpected expenses or rising housing costs become harder to manage, increasing pressure to liquidate property rather than restructure finances. Stricter credit affects more than borrowing power. It reshapes household behaviour. When refinancing is no longer available, homeowners cannot extend loan terms or lower monthly payments. Emergency repairs, medical bills, or temporary income losses must be paid from savings instead. As reserves shrink, stress compounds. Even responsible borrowers feel trapped as lenders prioritise balance sheet protection over flexibility. A home that once provided leverage becomes illiquid, limiting options precisely when financial adaptability matters most during economic shift. Preparation requires anticipating reduced access to credit before it disappears. Reviewing credit reports, reducing unsecured debt, and strengthening savings improves resilience. Some homeowners choose to access equity earlier under controlled conditions, while others reduce housing costs proactively. Stricter lending rarely causes immediate selling, but it removes escape routes quietly. Households that plan ahead retain control and timing. Those who wait often discover that credit disappears first, leaving selling as the only remaining path once financial pressure peaks and options narrow rapidly under tightening. Market conditions across regions worldwide today. Number 9. Rising HOA and community fees. Homeowners associations are increasing fees at a pace that surprises many property owners. As buildings age, shared infrastructure, such as roofs, elevators, parking structures, and plumbing systems, require major repairs. At the same time, insurance, utilities, and security costs continue rising. These expenses are passed directly to residents through higher HOA fees, turning what once felt like a minor monthly charge into a serious financial obligation that adds pressure on household budgets already stretched thin. The risk intensifies with special assessments, which arrive without warning and demand large lump sum payments. Owners may suddenly owe thousands to cover emergency repairs or insurance shortfalls. Condos and townhomes are especially vulnerable, since individual owners have limited control over spending decisions. Falling behind on HOA payments can trigger fines, legal action, or liens, creating consequences similar to misdeed mortgage payments. For many households, these fees become the tipping point where owning no longer feels sustainable. Preparation starts with reviewing HOA financial statements and reserve funds regularly. Strong reserves signal future stability, while underfunded associations often lead to sharp increases later. Homeowners should factor potential fee growth into long-term affordability calculations, not just current costs. Some choose to sell before major repairs or assessments occur, preserving flexibility and equity. HOA pressure alone may not force selling, but combined with taxes, insurance, and repairs, it accelerates difficult decisions. Early awareness helps households avoid sudden shocks and maintain control over housing choices. Before, community-level costs quietly limit options and reduce financial breathing room. Number 10. Demographic shifts and forced downsizing. Demographic shifts are reshaping housing decisions as 2026 approaches. An aging population faces higher medical expenses, reduced mobility, and changing household needs. Large homes that once fit families become costly and impractical to maintain. At the same time, inheritance rules and estate planning concerns pressure older owners to simplify assets. For many households, selling a home is not about desire, but about adapting to life stage realities that no longer align with the property they own. These transitions often arrive gradually, yet carry powerful financial consequences for long-term stability. Downsizing becomes a necessity when fixed incomes cannot support rising taxes, insurance, and maintenance. Some homeowners sell to fund long-term care, assisted living, or medical treatment. Others must divide assets fairly among heirs, forcing property liquidation. When housing wealth represents the largest share of net worth, selling becomes the most practical solution. Emotional attachment delays action, but financial math eventually dominates, narrowing options and accelerating decisions under pressure. This shift affects middle-class families as strongly as retirees across many regions globally, facing demographic change pressures by 2026 alone. Preparation begins with realistic evaluation of futures needs rather than present comfort. Reviewing healthcare plans, mobility expectations, and estate goals clarifies whether a home still fits long-term priorities. Early downsizing preserves control, equity, and choice, while delaying often leads to rushed sales. Demographic forces move slowly, but they are relentless. Homeowners who plan ahead respond calmly, protect financial flexibility, and transition on their own terms instead of reacting when circumstances force change. Such planning reduces stress and supports stable decision-making during unavoidable life transitions that impact housing choices. By 2026, the housing challenges discussed are unlikely to act in isolation. For many homeowners, pressure builds through a combination of rising interest rates, taxes, insurance, maintenance costs, and income uncertainty. Individually, each factor may feel manageable, but together they slowly reshape affordability. What makes this period different is how quietly these forces operate. There is rarely a single breaking moment. Instead, stress accumulates until selling feels less like a choice and more like a release from constant financial tension. Understanding these risks early restores control. Homeownership works best when costs align with long-term income, health, and lifestyle realities. When that balance shifts, adapting early protects equity, flexibility, and peace of mind. Selling does not always signal failure. In many cases, it reflects smart adjustment to changing conditions. Preparation allows homeowners to act on their own timeline, rather than under urgency created by shrinking options. Awareness is the most valuable tool. Reviewing finances honestly, planning for future expenses, and recognizing when a home no longer serves your needs can prevent forced decisions later. The goal is not fear, but clarity. Those who stay informed are better positioned to protect stability, reduce stress, and navigate housing decisions with confidence during uncertain economic cycles ahead. If this topic reflects what you're seeing around you, share your thoughts in the comments. Subscribe for more clear, grounded breakdowns on housing, money, and economic shifts. And watch our related videos to stay prepared, not surprised.